Have you ever wondered how your emotions can impact your stock market investments? It's a fascinating field of study, and the Pareto principle offers one way to understand it. This principle suggests that 80% of effects come from just 20% of causes. When applied to investing, it's clear that a small portion of our decisions can lead to a majority of our outcomes. Emotions and behavioral aspects are key players in these decision-making processes. Fear, for instance, can influence our choices dramatically. It's a powerful emotion that varies from person to person, shaped by our individual experiences and circumstances. Fear can make us overly cautious or drive us to take unnecessary risks in an attempt to avoid perceived threats. Cognitive processes also play a crucial role in financial decision-making. These mental mechanisms help us to gather, interpret, and use information, but our emotions can shape these processes, nudging us towards certain decisions and away from others. This interplay between cognition and emotion is a vital part of the investment process, influencing not just individual decisions, but market trends as a whole. As you can see, emotions play a significant role in investing. But how do these emotions affect market trends? The stock market is a battleground for bulls and bears, each influenced by their own emotions. In this ever-shifting arena, market psychology and behavioral finance play significant roles. They are the unseen forces that propel the bullish and bearish markets, driving prices up and down. At the heart of it all are human emotions: optimism and pessimism, hope and fear. These sentiments color the lens through which traders view the market, shaping their decisions and the ensuing market trends. Furthermore, the fear of missing out, or FOMO, can fuel the flames of market fluctuations. This emotional experience, coupled with the innate human desire for community and belonging, can lead traders to follow the crowd, sometimes against their better judgment. This herd mentality is a powerful force in the market, pushing prices beyond what the fundamentals might justify. To navigate this emotional landscape, traders often turn to market sentiment indicators. These tools provide a gauge of the prevailing mood among investors. Are they feeling bullish, filled with optimism about the future? Or are they bearish, pessimistic, and bracing for a downturn? These indicators offer valuable insights, helping traders to understand the emotional undercurrents driving the market. Now that we understand the emotional struggle of bulls and bears, let's delve into some common emotional pitfalls in investing. Emotions can often lead investors into costly traps. It's a truism that's been proven time and again in the world of investing. Let's explore some of the common emotional pitfalls that investors often fall into. One such pitfall is the tendency to change portfolios too frequently. This is often driven by the fear of missing out on the latest hot stock or investment trend. But frequent changes can lead to missed opportunities and unnecessary transaction costs. Another pitfall is selling winners too early and holding on to losers for too long. The thrill of a quick win can lead investors to sell a profitable stock prematurely, while the pain of admitting a mistake can keep them holding on to a losing stock in the hope that it will bounce back. A lack of understanding of investments is another common pitfall. Investing in something you don't fully understand can lead to poor decision-making and increased risk. Getting caught up in market frenzies is yet another trap that many investors fall into. The hype and excitement around a particular stock or sector can cloud judgment and lead to irrational decisions. Finally, there's hyper-loss aversion. This is the tendency to be overly sensitive to losses, which can lead to panic selling during market downturns and missed opportunities during market recoveries. So, how can you avoid these emotional pitfalls? Strategies include setting a target portfolio allocation, regularly rebalancing, focusing on selling shares with the lowest gains or biggest losses first, gaining a thorough understanding of your investments, avoiding the hype around market news, and being realistic about spending down assets in retirement. Avoiding these emotional pitfalls is key to successful investing. But what about the biases that influence our investment decisions? Investing isn't just about financial acumen, it's also about emotional fortitude. In the world of investing, two primary biases tend to take the wheel: loss aversion and overconfidence bias. Loss aversion can make us cling to losing positions, hoping for a turnaround, while overconfidence bias can lead us into excessive trading and unwarranted risk-taking. Fear and greed, two powerful emotions, often dictate our investment decisions, pushing us into hasty choices or causing us to freeze when action is needed. So how do we overcome these emotional biases? Knowledge is power. Understanding the market and recognizing these biases in ourselves are the first steps. Diversifying our investments can help spread the risk and mitigate the impact of any single investment going south. Setting realistic expectations and having a clear plan can prevent us from falling into the trap of overconfidence. Implementing stop-loss orders can help us cut our losses when necessary, and maintaining emotional detachment allows us to make decisions based on facts, not feelings. Overcoming these biases can help us make better investment decisions. But how has investor psychology been affected by recent events like the COVID-19 pandemic? The COVID-19 pandemic has had a significant impact on investor psychology. During these uncertain times, the relationship between investor sentiment and the performance of key stock markets has been put under the microscope. The research has shown a negative correlation between investor psychology and the performance of selected stock markets. This means that as negative emotions and pessimism increased among investors, stock market returns decreased. These negative emotions were not just confined to the trading floor. The pandemic's impact on individual mental health has been profound, causing increased anxiety, panic attacks, and other mental health issues. This emotional turmoil has spilled over into the financial markets, leading to sharp decreases in stock prices. Interestingly, previous research has shown a positive relationship between stock markets and investor sentiment. However, the pandemic has flipped this relationship on its head, showing us that when faced with unprecedented global events, investor psychology can take a drastic turn. The pandemic has indeed affected investor psychology and market behavior. Now let's talk about the importance of self-awareness and self-reflection in investing. Intelligence alone isn't enough for successful investing. Self-awareness and emotional management are just as crucial. Let's consider the case of long-term capital management, or LTCM. Despite being run by highly intelligent individuals, including Nobel laureates, the hedge fund collapsed in 1998. A stark reminder that intellect alone doesn't guarantee investment success. Emotional biases often cloud our decision-making process. Anchoring bias, for example, can cause us to stick stubbornly to our initial perceptions, ignoring new information. Then there's the fear of missing out, or FOMO, which can push us to jump on investment bandwagons, often when it's too late. And let's not forget loss aversion bias, the tendency to prefer avoiding losses over acquiring equivalent gains, which can lead to poor investment choices. To navigate these biases, self-awareness is key. It involves recognizing our emotional responses and understanding how they influence our decisions. Self-reflection, too, plays a vital role, helping us learn from our mistakes and successes. And of course, managing our emotions, not letting fear or greed dictate our actions, is essential in making sound investment decisions. Understanding and managing our emotions can indeed make us better investors. But what does research say about the impact of overconfidence on firm valuation? Overconfidence can significantly affect firm valuation. This was proven in a study examining the impact of overconfidence bias on the Saudi Stock Exchange. The researchers discovered that overconfidence had a positive and significant effect on firm valuation. This shows that our psychological state can greatly influence our financial decisions. Investors who overestimate their ability to predict market trends might end up buying overpriced stocks, believing that they can sell them at an even higher price. This overconfidence, though seemingly beneficial, often leads to excessive trading and unwarranted risk-taking. However, it's not all doom and gloom. Overconfidence can also drive market trends and influence firm valuations. When investors are confident, they are more likely to invest, increasing demand for stocks and subsequently their prices. But remember, the key is balance. Overconfidence can be a double-edged sword. It can propel us forward, but if left unchecked, it can also lead us down a dangerous path. Investing is indeed a psychological game. Understanding our emotions and biases can help us make better investment decisions. We hope you found this video insightful. If the information provided has been helpful, show us some love by giving this video a thumbs up. For more updates, don't forget to hit the subscribe button. Remember, understanding the psychology of investing is key to making better investment decisions. So keep learning and happy investing.